Charles Schwab Corporation stock price has plummeted 32% since March 8, 2023. This sudden drop has left many people wondering why a financial giant with $7 trillion in assets and 35 million accounts got caught up in the recent banking turbulence. The reason is twofold. First, like Silicon Valley Bank, Charles Schwab holds billions in bonds that have declined in value. These bond losses are a product of rising interest rates. Some in the financial services industry didn't anticipate just how quickly the Federal Reserve would raise its key rate as it tried to contain inflation. Many banks hold long-dated bonds with low interest rates, which have become increasingly unattractive as the Fed raises rates and new bonds with higher interest rates become available. But as long as the banks pledged to hold on to those older bonds until they matured, for accounting purposes, the lower values showed up as so-called unrealized losses on their balance sheets. Second, Charles Schwab is not just a brokerage firm but also has a large bank operation. The bank held roughly $28 billion in bond losses on paper at the end of 2022, similar to Silicon Valley Bank. So, is it the time to panic? And the answer is, not really. Here is why. Despite the unrealized losses, Schwab probably won't need to sell those investments to meet withdrawal requests from depositors. In a recent note to customers, employees, and investors, the brokerage's founder, Charles Schwab, and its chief executive, Walt Bettinger, went as far as saying there was a near-zero chance that they would have to resort to selling those investments. They also did a good job of explaining why the situation is very different and should not be a major concern. Here is what they had to say. Number 1, our stock price does not reflect the strength of our business. Stock prices go up and down, and we do not manage our business according to the stock price, but rather according to our long-term view on what is best for our clients and the health of the business. That said, we do not believe recent stock performance reflects our long-term business fundamentals and opportunity. As we shared for the week ending March 17, clients brought to Schwab more than $16 billion in core net new assets. We have attracted core net new assets of approximately $116 billion year to date through yesterday, and have added nearly $1 trillion in the past 2 years. We see strong flows continuing and remain confident in our fundamentals. Number 2, focusing attention on unrealized losses in our held-to-maturity portfolio is very misleading. These paper losses are unrealized and would only be realized if we had to sell those securities. The profile of our depositors is very different from regional banks. Given our significant access to sources of liquidity, there is a near-zero chance we'd need to sell any of our held-to-maturity portfolio prior to maturity. That would be akin to assuming a large retail bank would sell a substantial portion of its loan portfolio. Number 3, client deposits may move, but they are not leaving the firm. As is the case in every cycle, clients make choices about where to best allocate their assets. As interest rates have increased over the last year, our clients have made choices to reallocate assets within their Schwab portfolios, to reflect their preferences in this market. And in fact, we have actively encouraged them to do so. The important point is that those allocation decisions result in the assets staying at Schwab. Despite the events of the last 2 weeks, we have not seen any meaningful change in client behavior regarding their cash. Number 4, we have taken relatively little risk in our portfolio. We take very little credit risk. More than 85% of our assets are in a high-quality, liquid portfolio invested in government or agency-backed securities. As a comparison, most major banks have a majority of assets in multi-year residential and commercial loans with significant duration, varying credit quality and little liquidity. We feel comfortable that our portfolio carries materially less credit, duration, sensitivity to rate changes, and liquidity risk than many of those other banks. Number 5, the way we manage our balance sheet is very straightforward and hasn't changed. We invest in high-quality securities with a portfolio duration that today is around 4 years, and just over 2 years in our available-for-sale portfolio. Because of the quality of our portfolio, we are able to maintain access to high levels of liquidity that allow us to hold these investments to maturity if we choose. We have taken this same approach since we began offering banking services almost 20 years ago. We did not make a bet on interest rate movements going down or up, and we did not extend our portfolio long-term like some other institutions. Number 6, we do not forecast Fed rates or make investments based on where rates are going. In our regular business updates, we have relayed the consensus opinion of the market at the time. These are not our predictions. We never base our strategy off our own view of interest rates. We share those market opinions in the context of helping analysts understand our business model and potential financial performance. Number 7, comparing unrealized losses across firms with different business models can be misleading. Schwab Bank has a different business model than traditional banks. Our deposits come from transactional cash in clients' brokerage accounts that is swept to our banks. We use about 10% of that cash to fund loans to our existing clients, and with the remaining 90%, we buy securities, the vast majority of which are backed by the US government. With rates moving up, the fair value of all fixed-rate assets, loans or securities, has gone down. But given that our securities are very high quality, we fully expect our securities to reach par at maturity, which means the unrealized paper losses will decrease over time. Because a much higher percentage of our assets are securities, and traditional bank loans are not disclosed the same way, our paper losses may appear larger than those of traditional banks. But that assessment lacks the appropriate context. In reality, our portfolio has less credit risk and is actually less sensitive to changes in interest rates than many large banks. Wow, those are some solid reasons laid out there. However, as interest rates rise, Schwab's cost of borrowing is also increasing. The company usually turns to its deposit base for funds, but that has been steadily shrinking as customers move their money into more lucrative accounts with higher yields. As a result, Schwab's earnings may be lower than previously thought. But despite the pessimistic projections, there are still many reasons why investors and clients should not panic. Schwab is a diversified financial giant with access to plenty of capital, and its deposit base is made up of retail customers, unlike Silicon Valley Bank's customer base, which mainly consisted of startup founders and venture capitalists. Well, if you panic and start shooting before asking questions, it becomes a self-fulfilling prophecy that can bring down literally any financial institution in the world, but that is not the way you should be really managing your money. As always, it's important to do your own research and make informed decisions before investing your money. That's it for today's video. If you found this information helpful, please give us a thumbs up and subscribe to the channel to make a better sense of your money.